Hey guys, let me just get this set up a little bit better here. I don't know if you can see my screen or not, so hold on a second. There we go, there we go. All right, what's going on, Jim, AKA Carl? I hope you're doing well. All right, so guys, I'm going to make this board so that you can see it here and try to cover sort of a Clint Eastwood version of real estate. Actually, if you can just drop into the chat that you can hear me, because I think I had this going where nobody could hear. Could you say something in the chat like I can hear you fine, or say Chicago Cubs or something like that? I'm assuming you can't hear me here, so. Oh, okay, good. All right, very good, very good. Appreciate that, Jeannie. Now I can see you guys' comments. So look, if you have questions, it's not really a dialogue in the sense that we're not on a Zoom meeting, but if you throw some stuff up in the comments, then I'll look at that and we'll be able to cover some things. But what I wanted to do is give you, like I said, sort of this Clint Eastwood version of the real estate world that we're entering, which means the good, the bad, and the ugly. To be perfectly candid, all of it is probably good, but some of it is suboptimal, and some of it is takes on a little bit more risk than what you need to take on when you're doing real estate deals. And the Clint Eastwood reference is to the movie The Good, the Bad, and the Ugly. So why don't we go ahead and just start with two very, very common strategies. When you're investing in real estate, you're really looking at either buying properties at a really low price so that you can then assign that contract to someone else and just exit and get a payday. That's certainly fine. A lot of folks start out doing that. Others will buy properties at cheap enough prices that they can rehab the property and then sell it for full retail, move on to the next deal. That certainly makes sense. Then there's the concept of using your credit or using your cash to buy and hold real estate. You can certainly build wealth that way by paying down loans that are on there and using leverage, so to speak, to get cash flow and to build equity over time, effectively having tenants pay down your mortgage on your behalf. A lot of people can do that. You can juice those things up by putting Airbnb type tenants in there. So there's a lot of risk taking and there's a lot of speculation and there's a lot of reason to be involved in real estate because more millionaires have been created in real estate than really in any other industry. The thing of it is, we're living in an environment where we basically have pretty doggone close to free money right now. You can borrow money at extremely low interest rates, and it's really distorting capital markets in a way that is leading to tremendous risk taking. Not to get into the whole situation with GameStop on Wall Street and that travesty that's occurring, I could get off on a diatribe about that, but the bottom line is that what we've really done is we've lowered interest rates so much trying to spur economic activity that we've really created this bubble in housing prices. I don't know if it's a bubble, but we've seen a tremendous increase in housing prices, tremendous demand for housing. We're making it so that our children are going to have a very difficult time buying houses, potentially buying stocks. The same thing has happened with stocks when you can borrow money this cheap. But the segue that I want to make on that is that as it becomes a little bit easier to get financing and get credit and make numbers work, people tend to take tremendous risks. And I'm going to talk to you about a much better way of utilizing real estate to build wealth, where you don't have to take risk and you don't have to use your own cash. In fact, your return on investment is essentially infinity. And it's infinity because if you don't have any money into it and you get a return, you've made an infinite investment versus, putting $50,000 down on a multi-unit building or something like that, and then you have cash flow, and maybe you're making $10,000 a year in net cash flow on that. So good, you got a 20% return a year. So I'm not going to sit here and tell you that it's the wrong thing to do, but I am going to tell you that you're absorbing more risk than you need to if you're implementing those methods. So I'm going to start here telling you about the good, the bad, and the ugly. Let me just look in here and see if we have any particular questions. Yep, Rob, Chicago Cubs, that's for you. Nick, there we go. I decided I even got my sweetness on, right? Or Chicago Bears. So, all right, so look, let's talk about this concept of wholesaling properties. A lot of people get started with wholesaling, but you're not going to build tremendous wealth unless you have a team of 60 callers for you and you scale up to a very big degree. You're constantly having to churn through properties. You don't have a golden goose that keeps laying a golden egg. You might find a golden goose that lays one egg, but then you're out of the deal. So some people prefer to do that, but it's got its problems. For one thing, if you're going to assign a contract and get cash on it, then you're effectively a middleman. And in that sense, you have got to, number one, you've got to have a property that has a tremendous amount of equity. If, just to use smaller numbers, if there's a $100,000 property and there's anything more than $70,000 owed on that property, which is probably a significant chunk of properties that you might be working on, you can't really do a wholesale deal on that. Because even when the person comes in with cash to either double close with you or whoever you're assigning the contract to, they're not going to take the assignment if there's more owed on the house than what they want to pay. Whereas we can do those kinds of things when we talk about the way that we're doing real estate, and I'll get into that. But the first thing is you got to have a tremendous amount of equity, preferably free and clear, or lower than 50% loan to value, so that you can have the potential to buy it really cheap. But that's the next problem with wholesaling, is you got to get the property extremely cheap. And I'm not saying it's impossible. Look, you can find needles in a haystack. Look at what happened with BlackBerry stock this week. BlackBerry stock is up. I could probably go out and sell a BlackBerry phone to somebody today, right? But I'd have to talk to a hell of a lot of people to find somebody interested in buying a BlackBerry phone. There's other reasons to be invested in BlackBerry because of other technologies they have, but as far as phones go, not too many people are buying BlackBerries. Well, look, in the older days, not so old, but before the internet, it was very easy to get properties at a low enough price where we could assign contracts and we could get them cheap enough because there wasn't as much readily available information on what your property was worth. Any fool can punch in the address of their house on the internet and get an appraisal on their property immediately. Didn't used to be able to do that. So and then you're also going to be competing against people like me who have lots of marketing dollars. You're going to be competing against big wholesale outfits. It can be the We Buy Ugly Houses guys, that's the Home Investors franchise people. It can be what they call the iBuyers, which are the Zillows, the OfferPads, trying to think of what the names of the other companies are, but these guys will have algorithms that will beat your offer, and frankly, a lot of the sellers, after they talk to you, are going to be smart enough to go and bounce whatever you offered them off of somebody else who might have greater credibility because of a tremendous web presence, and it just makes it more difficult. I'm not trying to discourage people from going out and trying to do wholesale deals, but understand that that method of investing in real estate only earns you one check. You've got to have a house that has a lot of equity. You've got to get somebody to agree to an extremely low price on the house, and if you can accomplish that, then by all means do it. But you're only going to get one payday. And to make matters worse, you're generally working on pretty junky houses, not the most fun houses to work on, not usually in the greatest neighborhoods, and there's this intense competition. So feel free to do wholesale deals. We'll do wholesale deals in my group. They got to come and smack us across the mouth. We're not really out there pursuing them, but people do come to us where they just want to get cashed out. They do have equity, and because of the need for speed, they're willing to take a low cash offer, and then we can either go in and rehab it or we can assign the contract. So I'm not against it. I'm just saying, among the different ways of doing real estate, this is probably my least favorite. And when you look at having to spend tens of thousands of dollars potentially, or maybe $10,000 to get proper coaching and training on how to do it, and then you look at the amount of marketing that you have to do to attract these needles in the haystack, I don't subscribe to the idea that that's the best way to get involved in real estate, and I wish people would quit promoting that as the greatest thing since sliced bread. It might have been back in 1987, in the early 90s, but things have changed, things have evolved, and there's a much better way. And what you need is a more robust strategy. You need a strategy that allows you to buy any house from any seller and still be able to profit on it, regardless of what the seller's disposition is. And that's what we're doing here. So now let's look at really the other side of the spectrum. This would be the buy and hold crowd, or it's not always buy and hold, but there's usually an element of rehab involved in this method that I'm seeing on TikTok, and I'm seeing it on Facebook and in YouTube, called BRRR, which is an acronym, and it stands for buy, refinance, just like I talked about, right? Interest rates are low. You can get a loan. Now you're gonna be personally liable. These are recourse loans most of the time, and you've now got your credit on the line. It's fine. A lot of wealth is created out of using good credit this way. I mean, not the strength of your credit, but using credit to invest in things that appreciate versus depreciate. So I'm with that, but I'm not really with the idea of using your own credit to purchase real estate when you just don't have to. There's houses out here by the thousands that you can get with non-recourse debt, where you don't have to risk your livelihood, your savings, your family's future. Just talk to people who went through 2008. A lot of people went out and got financing on houses in their own name and saw tremendous appreciation, so they took bigger and bigger risks. And then when the market crashed, they found out that their net worth went from plus 5 million to negative 5 million. And that's a hell of a hole to climb out of. A lot of people are still climbing out of that. And I see a lot of the youngsters today who really weren't around for 2008. I mean, maybe they were in high school or something like that, but they're not really familiar with what can happen in these speculative bubbles and these manias that we're living in right now because of the distortions that have been created from Federal Reserve money printing and the way that capital is being allocated today. It is a brave new world, and we've set the stage for some potential disasters to come down the line here. So let's just talk about the method. You can buy, that's the B. Now you've got to get the house with that method. You still got to get the house pretty cheap relative to the value, because And usually there's going to need to be a certain amount of repairs on the house. So again, we're qualifying houses. We're trying to thread a needle with the seller. I much prefer the strategy of being able to do whatever the seller wants to do, and then aligning them within one of the outlets that we have where we can profit from any seller disposition. But with BRRRR, which is buy, refinance, then you rehab it out of the money that you got on the refinance, and then you rent it and you repeat it. Okay, so buy, so you have a $100,000 property, just to use that as an example, and maybe you get the property for $60,000 and it needs $15,000 of work. Well, you should be able to go get a 75% loan against the after repaired value of $100,000 if you're lucky and if you're resourceful, right? Not everybody's going to be able to do that. That's another thing. If you don't have credit or you don't have, some kind of credibility that you can show to the lender, then, you're kind of out on this method. Unless you get the property extremely cheap. Yeah, you can go pursue private lenders. Yeah, you can use hard money lenders, but there's a reason that they call them hard money lenders, because the money is hard. It's hard to pay back, and it's hard to deal with the interest that you're going to pay on it and the points that you're going to pay on it and those kinds of things. And it's recourse debt. You're probably going to be personally liable on that if something goes awry. But the idea is, take a $100,000 property, you get it for $60,000, you put a $75,000 loan on it, you use the $15,000 to repair the property, and now you've got an asset that you can rent out and reap the rewards of the cash flow on the property. Maybe the property's cash flowing, and maybe the property appreciates in value. Now, you're only going to be able to do that maybe like 10 times if you're using normal financing structures with banks, traditional financing structures. There's a limit on how many loans you can have out there, even as an investor. So, you're limited in your scale. But, the idea itself isn't bad. It's just that why put yourself through having to do a lot of rehab, going out and getting, hard money. If you can get private money on the right terms, it's totally fine. But putting hard money on it or putting bank financing on things when you just don't have to. So what I would recommend, so again, we're saying it's buy, refinance, repair, rent, repeat. Buy, refinance, repair, rent, repeat. Why don't we just drop two of the R's here, which is the refinancing and the rehab? The two worst parts of the BRRRR method. I don't want to have to refinance. Why don't I just take over a loan that's already on the property, or why don't I just create new financing with the seller? I'd rather do that. That drops the whole refinance out of this. Rehab, are you kidding me? I don't want to be touching a hammer. Look at the sun outside. I don't know if you can see. It's a beautiful, beautiful day out here. See, I guess you guys can't really see it's a beautiful day outside. I'm not talking about, dealing with rehabbers and contractors and doing that kind of stuff if you don't have to. And you don't have to. That's the beautiful thing out of it. So why don't we just buy, rent in a way where we get paid up front, paid in the middle, and paid on the back, and repeat? Why don't we do it that way? To me, that makes a whole lot more sense. So keep in mind, you can do this method, but you need a house with equity. The seller is still going to have to take a relatively low price on it. You can't really pay full retail on it. You're probably going to have to personally guarantee debt, and you're going to have to deal with the rehab. So that's why I would say that they're not wrong methods, they're suboptimal methods. And I agree with what Corey is saying in here as well. Now, let's contrast this now to the good. Okay? I can profit on any house from any seller. And that's what we teach in here. And the reason that we can profit on any house from any seller is we simply take whatever the situation was with the house and whatever the situation is with the seller, and we plug them into one of several solutions. So let's boil that down. Either the seller is going to be willing to do something where we get, a discount, Okay, so we can buy the house cheap enough that we can assign our contract, we can do a double close with a rehabber if the property needs rehabbing, or we can just buy it at a low enough price that we can resell it and make money on it. That does happen some of the time, but that's not the majority of the time. So they're going to do something like that, or we can buy the house for full price. And the way we buy it for full price is we ask the seller to be patient in getting that full price and to take monthly payments from us for a period of time until we cash them out in full. And that's the trade-off that the sellers have to make. And then I'll pursue that a little bit more. The third thing that they can do is they can just sell it traditional for full retail. But guess what? If a seller is going to sell their house the traditional way for full retail, the buyer that comes to the table is going to be represented by a realtor more than 90% of the time. I don't care if somebody is selling it by owner. If they're selling it by owner, most of the time, those by owner sales happen where a realtor brings a buyer to the table. Why? Well, because buyers perceive realtor services is free. Why? Because the seller pays the freight. The seller pays a commission. The buyer doesn't have to pay a commission. Buyer gets driven around in a Cadillac Escalade, spinning on 22s, taken to Starbucks, taken to lunch, treated like royalty, sucked up to. Makes them feel good after a long week of work, being treated like royalty all weekend, because they are the prime buyer. They've got the ability to get a loan, and they'll pay a retail price. So everybody wants that buyer, right? So they're represented by realtors, which means the seller is going to pay a commission. They're going to pay a hefty commission. You know, on a $500,000 house, a 6% commission is 30 grand. That's a lot of equity that you're just giving up to somebody. So when we have a seller who is telling us that they just want to get cashed out and they want to sell retail, and we can't get them to sell it at a discount because it wouldn't make sense for them, and we can't get them to sell it at full price and take monthly payments for a period of time because of one reason or another, then they're telling us that they just want to sell it for retail for a cash to a regular cash buyer who goes out and gets a mortgage. They're going to have to understand, and it's pretty easy to express to them, that 90% of those buyers that they're looking for, that they're trying to attract, are going to be represented by a realtor. And if that's the case, are they willing to pay a commission to that realtor? And most of them will say, yeah. If an agent brings me a buyer and I like the offer, then I'll pay a commission. Okay, well, you need to be represented. You wouldn't go to a court of law where the other side has an attorney and you don't. That's a recipe for disaster. Don't take the biggest asset that you have and then negotiate against a professional realtor. Get representation and we can help you. And we can help all across the nation, and I show people how to do this. We can help all across the nation, even if we're not realtors ourselves. I think it's a good idea to get a realtor license, but if you're not, we can get a realtor to help them and we can make money on that referral. In this way, it allows us to be consultative with the seller. But the point being that they're going to need representation. And the reason that they're going to need representation is because the buyer's agent will wreak havoc with them in the negotiation. And we can make the case that, look, we wrote the buyer's playbook. We know exactly what they're going to do every step along the way. We know everything they're going to do relative to inspection concessions and all kinds of discounts and things that they're going to ask for in the escrow period when they have more and more leverage. As you get closer to the closing date, that buyer's agent has a lot of leverage over you. You packed up your stuff, you have a moving company come, and then the next thing they do, they're going to walk through and they're going to say, you know what, I don't like that I heard this sound coming out of the furnace. I think I need $5 grand for a new furnace, otherwise we're not closing. That's the kind of crap that goes on. You need professional representation, so we make that case. So I'm belaboring the point, but the point being that across the spectrum of sellers' methods for disposing of their property, we can help. And it allows us to convert all of our leads potentially. We don't have to thread the needle for a house that has a lot of equity, and then thread the needle again for somebody who's willing to take a huge discount. We don't have to do that. We simply listen to what the seller says and plug them into the right solution and then make money within that solution. It allows us to convert a tremendous number of sellers relative to these other strategies. It no longer becomes a question of whether they like your strategy. It becomes a question of whether they like you. Because they are going to do one of the things that we service. So in that sense, we can just consult with them on what are the trade-offs for each method of disposing of their property and what's in it for them and what the trade-off is against that. And in doing that, you develop rapport with them, you develop credibility with them, you set the stage for getting a deal with them either in the follow-up or getting to meet them and getting out to the house and being able to structure some kind of a deal that allows you to not have a wasted call with that lead. So that's why you're able to improve your conversion ratio. That's why you're able to make money on any house with any seller. The seller simply has to understand that no matter what they do, just like anything in life, it's a series of trade-offs. If they want to get cashed out right now, the trade-off is they're probably going to pay a realtor commission. Okay, so they're going to have some of the equity siphoned off of their house, but they might get cashed out a little bit more quickly, but they're going to pay for it. Okay, contrast that to we can give somebody full price, but they just have to be a little bit patient. In fact, we'll give them more than full price because we're going to pay them monthly. And if they can be a little bit patient, then they get all the money out of their house that the house earned, that the house deserved, plus a little bit more monthly. Now, lest you think that people aren't willing to do this, let me remind you, look at people that have put their house up for rent. If somebody has put their house up for rent, they have already agreed to take a monthly payment for a period of time. We're 90% of the way home. You simply call somebody up who has their house for rent. Hey, look, I see you have your house for rent. I will rent the house, but only on the condition that you'd be willing to sell the house during the term of the lease. Would you be willing to do that? You'll find that most people will. Well, it depends on what the price is. Well, what do you have in mind? What's the least you can take? You'll also find that a lot of the people that have their houses up for rent only have it up for rent because they couldn't sell it. They were trying to sell it in the first place. So you're like riding in with a panacea solution for them. You'll both rent it and buy it from them. So look, I'll rent it from you. I just need the ability to buy it during the term of the lease. Are you willing to do that? And when somebody is willing to do that, you've got yourself a great opportunity to get paid multiple times on the house. And the reason you can get paid multiple times on a house that you've taken over, whether you're renting it with monthly payments with an option to buy it at some point during the term of the lease, or you're simply buying it for a price to be paid later while you make monthly payments along the way, or while you pay that price off with monthly payments along the way. The difference between buying with seller financing and buying on a lease option. When you get one of those kinds of deals, you set yourself up for a tremendous payday without taking any risk and without having to use any of your own money. That's what I love about this strategy, and that's why I call it the good. And the reason is that we can easily install somebody in that house that we've either bought with seller financing, where we're making a monthly payment for a period of time until we cash them out in full, or we're renting from the person who advertised their house for rent with the option to buy, and we simply install a tenant buyer in there that we're going to get qualified for a loan to cash everybody out, to cash us out at a higher option price than we gave our seller or landlord, so to speak, that we called on there for rent by owner. So one, we're going to be getting a down payment from that tenant buyer that we're installing. That's going to be bigger than what we're giving the seller. Most of the time, we're not giving the seller any kind of a down payment. So that's payday number one. And if you want to follow with this right here, we can do this on a house that has no equity. We don't have to thread the needle looking for a house with equity. If the house is worth $100 and they owe $100 on it, It just matters what the payment is. Full price is okay. We don't need any cash for this because we're going to have our buyer set up and we're going to fund anything that we do out of our buyer's proceeds most of the time, or you can put a little bit of cash out. It's so little cash you could do it on a credit card and pay it off out of the buyer's down payment that you get. Okay, you don't need cash, you don't need credit. You can fund everything out of the buyer's money, or you can use a little bit of cash and room on a credit card or something like that to get it going. But why do I say 3 to 100 plus paydays on the same house? The reason for that is that there are really 4 spreads that we go for in deals like this, okay? The first spread is that chunk of money that we have coming in from our buyer that we don't have to share with our seller or give to our seller because they just wanted the house rented, or they just want to start getting monthly payments on this. They want us to take over their debt, for example. That would be an example where the house has maybe got $100,000 of value and they owe 95 on it. Well, what are they going to do? They can't get any money out of that anyway. They just want the debt relief and to move on. So we take over the debt on that, but we get a down payment from our buyer that we didn't have to give our seller. If it was a rent type of thing where we're renting the house with an option to buy, same thing. We're not, we tell the seller, look, landlords don't get down payments. If you want a down payment, then you sell it to me. And even then, I'll give you a good reason why you don't need to get a down payment on this. And we're creating 4 spreads. That first spread is the difference between what our buyer is giving us and what we have to give our seller. Okay, that's our first chunk of money. We use that chunk of money really to buy the house, pay closing costs and those kinds of things. And in that sense, we're buying it for no money down and not using our own credit because the seller is effectively financing it or leasing it to us. So we don't need to go through all of these steps over here. We can accomplish the exact same thing in terms of building long-term wealth, getting potential appreciation on the property, getting debt paid down on the property, and getting cash flow on the property. But that's our first payday. So what's our second payday? You see, I say you can get hundreds of paydays on the same house. Well, that's the difference between the monthly rent that we're getting from our buyer and what we're having to pay our seller. And that happens in January and February and March and April and May and June and so on and so on and so on over the term of the lease. So there's another 12, 24, 36 more paydays right there. Okay, what's the next payday? The next payday is that we will have a price on the house that is less than what we're selling it to our buyer for. So we make that spread. And if we don't make that spread, it's okay. Because if they don't exercise their option, we're selling it on a lease option. If they don't exercise their option at that time, they can be moved on and we bring someone else in to give us another down payment and more monthly payments, and maybe they qualify for the loan that cashes us out. All the while, we're paying a loan down if we own the house, or all the while, we're taking our price down while we own the house because our price to the seller on an option is always the mortgage balance at the time of close plus the equity at the time that we signed. Or if it's a free and clear house, we're going to get some credit on our payment to them against the price. Okay, so we're owing the seller less and less and less. A luxury that we don't usually give our buyer, except for when we're doing my loan qualification assistance program, which really is just a premium rent that we're getting. So that would be the third tranche of spreads, right? These back-end paydays that either happen or don't happen, paving the way for you to bring a new buyer in and start the whole process over again. The other payday that happens is frequently somebody will be ready to cash you out because they qualified for the loan, they let you know that, and you can go back to the seller, and then you might have 5, 10, 15 years left paying the seller off based on the financing that you created or based on the length of the lease and the renewal terms that you gave yourself. And you can go to the seller and say, hey, everything's been great over time. I'm glad to keep things going as they're going, but what if I could just give you a big chunk of cash in the next 30 days, exercise my option right away? Can we talk about doing it for a little bit less? Otherwise, I'm just going to keep leasing it. And you can negotiate a discount on that, which increases the spread between what your buyer is bringing in and what you have to give your seller. So the point being, lots and lots of paydays over here. Lots and lots of paydays. You've got the difference between what's coming in on a down payment and what's going out. You've got the difference between what's coming in monthly and what's going out. You've got the difference between the price that you're getting and what you're going to pay out to the seller. And a time spread. That time spread is critical. If I take over debt that was established on a 30-year loan, $100,000 house, they owe 95, they can't make the payments anymore, they got laid off from COVID, they got to go somewhere else, we take over that debt. Well, I got 28 years to pay that off. How many lease option buyers can I go through in 28 years? If I'm offering 2-year lease options, 18-month lease options, 3-year lease options to my tenant buyers. How many times can I repeat this process? How many houses do you have to do to get incredibly wealthy? Not that many. This is what I show you guys how to do in the program. So anyway, I hear my phone going off, and I'm not sure if I'm getting questions or not. I'm going to look through the chat here. If anybody is not already in the program and you're just in the group and you want to learn how to do this a little bit more, you can schedule a call or shoot me a message and we'll get you on a call. If you're not interested in the implementation help, specifically, personally, there's free trainings in the group and there's free courses that I can send out. I've got a mini course that I can send you. And beyond that, let me see if there's any questions here. I'm looking in the chat. I don't think so, but I know I heard my phone going off here. Uh-oh. I got a couple people saying they can't hear me and some people saying they can hear me. So I'm not exactly sure what the situation is, but I'm assuming you guys can hear. So anyway, that's what I wanted to cover with you guys this morning. I'm going to start doing more of these Facebook Lives. I'm going to start, if you guys want to ask questions in the group, and I can I'll answer them in the group, but I'll also maybe keep a running tally, and we'll start doing more of these lives on the weekend or, whenever it's appropriate, so that we can get your questions answered and get you all some help, because this is really the greatest time I think I've ever seen as far as being able to set yourself up to build generational wealth using real estate. You got a bunch of people teaching the wrong strategies, a bunch of people taking unnecessary risk, and not very many people doing it the right way, which is this way. And this is it's the most. I should pare back on saying that this stuff is the wrong way. I'm just saying it's sort of like, why eat Spam when somebody's serving you a cowboy ribeye steak, right? Unless you're a vegan, right? I haven't eaten meat in 2 years, so but I remember what it used to taste like, and just because my cholesterol got really high. So anyway, I only speak about it in metaphor, but. All right, guys, so, did I just lose the screen? There we go. So, the net of it is you guys are in a really good spot if you're taking on real estate investing. Feel free to do these kinds of deals. If you're going to do these kinds of deals, understand what happened in 2008 and understand when you personally guarantee debt and use your own money, you're now carrying risk that you don't have to carry, because these deals are out there by the thousands. Where you can get seller financing, where you can lease a property with an option to buy. Look, they already have their house for rent. Why wouldn't they lease it to you? They're advertising for someone to lease it. So I'll lease it. I just want to be able to buy it during the term of the lease. Easy, right? And then if they won't do any of those things, we either get a realtor license or have a realtor on our team, or refer it out and make money. That's how we convert leads. That's how we get return on investment on all these leads. So anyway, that's what I wanted to share with you guys today, and I'm going to go ahead and close down the live, and you can follow up with any questions in the comments or hit me on Messenger, and we'll go from there. Jim or Carl, I see your question in there. Listen, man, just schedule a call with me. I'd like to catch up with you. it's going to depend on what you need and what we provide you, because it's going to be tailored for you. So go ahead and hit me up if you want to get on a call. And the rest of you guys, I hope you have a wonderful weekend. You know how to reach me. Comment in the group if you need anything, and we'll catch up with you all on the flip side. Be good, guys.